The age of easy money in the United States refers to a period of time characterized by low interest rates and a significant increase in the availability of credit. This period began in the early 1980s and continued through the early 2000s, and was fueled in large part by a number of factors, including changes in monetary policy, financial deregulation, and technological innovations. To fully understand the age of easy money in the United States, it is helpful to first explore the factors that contributed to this period of economic growth and prosperity. One key driver of this era was the Federal Reserve's decision to adopt a more accommodative monetary policy, which meant that interest rates were lowered to encourage borrowing and investment. This was in contrast to the tight monetary policy of the 1970s, which was characterized by high interest rates and limited access to credit. Another factor that contributed to the age of easy money in the United States was financial deregulation. In the 1980s, a number of laws were passed that removed many of the restrictions on financial institutions and allowed them to engage in a wider range of activities, including trading in new financial instruments such as derivatives. This deregulation helped to create a more fluid and dynamic financial market, which in turn fueled economic growth and made it easier for people to obtain credit. At the same time, technological innovations were also driving economic growth in the United States. The development of the personal computer and the Internet revolutionized the way that people did business, making it easier for entrepreneurs to start new ventures and for established companies to expand their operations. This technological progress also helped to create new industries and jobs, further fueling economic growth and prosperity. All of these factors combined to create an environment in which credit was cheap and readily available, and in which people were encouraged to borrow and spend. This led to a number of significant changes in the economy and society as a whole. For one, the age of easy money led to a significant increase in consumer debt. As credit became more readily available, people began to borrow more and more money to finance their purchases. This led to a boom in the credit card industry, as well as a rise in other forms of consumer debt such as auto loans and personal loans. The easy availability of credit also contributed to a housing boom in the United States. With low interest rates and easy access to mortgages, many people were able to buy homes or invest in real estate for the first time. This led to a significant increase in housing prices, and many people began to view real estate as a surefire investment. The age of easy money also had significant implications for the financial sector. As financial institutions became more deregulated and new financial instruments were created, the financial sector became increasingly complex and interconnected. This made it more difficult to understand and manage risks, and ultimately contributed to the 2008 financial crisis. In the aftermath of the financial crisis, the age of easy money came to an end. Interest rates were raised, credit became tighter, and financial regulations were tightened. Today, the United States is in a period of more moderate economic growth, with interest rates at historically low levels, but still higher than they were during the age of easy money. Let's explain some terms. What are derivatives? Derivatives are financial instruments that derive their value from an underlying asset or group of assets. They can be used for hedging, speculation, and arbitrage. Here are some pros and cons of using derivatives. Pros. 1. Hedging. Derivatives can be used to hedge against potential losses in other investments. For example, a company might use a derivative to hedge against fluctuations in the price of a commodity they need for production. 2. Leverage. Derivatives allow investors to leverage their investments, potentially increasing their returns. For example, an investor might use a futures contract to gain exposure to a large amount of an asset with a relatively small initial investment. 3. Liquidity. Derivatives are generally highly liquid, meaning they can be bought and sold quickly and easily. This can be advantageous for investors who need to quickly adjust their positions in response to changing market conditions. Cons. 1. Complexity. Derivatives can be complex financial instruments that are difficult to understand. This can make it challenging for investors to evaluate their risks and rewards. 2. Counterparty risk. Derivatives are often traded over the counter, OTC, meaning that they are not traded on a public exchange. This can introduce counterparty risk, or the risk that the other party to the trade may not be able to fulfill their obligations. 3. Speculation. Derivatives can be used for speculation, which can lead to increased market volatility and potentially destabilize financial markets. 4. Amplifying losses. Derivatives can amplify losses, particularly if investors use leverage. This can lead to significant losses that may be difficult to recover from. In summary, derivatives can be useful tools for managing risk and increasing returns. But they can also be complex and introduce new risks into a portfolio. It is important for investors to understand the risks and rewards of using derivatives and to use them judiciously. What is the difference between accommodative monetary policy and tight monetary policy? Accommodative monetary policy and tight monetary policy are two opposite approaches used by central banks to influence the economy. Accommodative monetary policy, also known as loose or expansionary monetary policy, is a strategy used by central banks to stimulate economic growth by increasing the money supply and lowering interest rates. This is typically done by reducing the reserve requirement ratio for banks, purchasing government securities on the open market, and lowering the discount rate at which banks can borrow from the central bank. by making credit more available and less expensive.
This policy is designed to encourage consumer spending
and business investment, thereby boosting economic growth. On the other hand, tight monetary policy, also known as contractionary monetary policy, is used by central banks to slow down the economy and control inflation by decreasing the money supply and raising interest rates. This is typically done by increasing the reserve requirement ratio for banks, selling government securities on the open market, and raising the discount rate by making credit less available and more expensive.
This policy is designed to discourage consumer spending
and business investment, thereby slowing down the economy and reducing inflationary pressures. In summary, accommodative monetary policy is used to stimulate economic growth by increasing the money supply and lowering interest rates,
while tight monetary policy is used to slow down the economy
and control inflation by decreasing the money supply and raising interest rates. What we need today? Give the answer yourself.
The age of easy money in the United States
was a period of significant economic growth and prosperity, fueled by low interest rates, financial deregulation, and technological innovation. This era led to a significant increase in consumer debt, a housing boom, and a more complex financial sector. While this period of economic growth had many benefits, it ultimately contributed to the 2008 financial crisis and led to significant changes in the way that we think about credit and finance. Like, subscribe, share the knowledge and information through our channel.
Thank you.